Hello, good evening, and festive greetings to all. I hope you've all had a delightful Diwali week. I am Shikha Sood, and I lead mutual fund products at Edelweiss Asset Management. Today, the focus of our call is on providing you with a comprehensive update of the Edelweiss Greater China Equity Offshore Fund that feeds into the JP Morgan Greater China Equity Fund. This fund in turn strategically invests in companies across mainland China, Hong Kong, and Taiwan. As we are all aware, navigating the rapidly changing Chinese economy poses its own set of challenges. And therefore, it's always been our endeavor to share timely updates with all of you. To shed light on the intricate details, we have with us today Alexander Treves, Managing Director and Head Investment Specialist Team in Asia from the Emerging Markets and Asia Pacific team in Singapore. Alex will share insights on the Greater China region, dissecting the domestic as well as global factors that influence the Chinese markets. Of course, post that, he's going to be sharing with us the nuances of the fund's portfolio structure. And he's here to answer any questions or queries that you may have. So please feel free to post any questions that you have in the comment box. We shall be taking it towards the end of the session. Also, I'd like to highlight our timing for this call seems great, as Chinese President Xi Jinping has just concluded his Asia Pacific Economic Cooperation meeting in the US. And I'd like to quote President Biden hailed the talks as some of the most constructive and productive discussions we've had. So we'd like to hear more of that during the call today. So a special thank you, Alex, for joining us this late evening from Singapore. We have a jam-packed agenda today, and while many of our participants are returning from a rejuvenating Diwali week, we can expect a very enthused and engaging session with our audience. So yeah, thank you, Alex.
Thank you.
So Alex, just before I come to my first question, I'll just like to lay the context for the next in about 2 to 3 minutes. So this year commenced with considerable optimism surrounding Chinese investments, and with abandonment of the zero COVID policy, the markets were up 60% from the October lows. Equity multiples were in line with their long-term averages. So this, combined with a couple of other aspects, led to the positive sentiment around China investments. And also, I'll just like to summarize a couple of points we made in our last call with our participants in July. Essentially, if I can divide them into 3 key areas. One was that the COVID is no longer the primary concern. But however, the COVID policy's hangover that has had on consumer confidence is significant. And of course, the property market weakness has weighed on the household sentiment, even though the household savings are at a high levels right now. So therefore, we can expect a gradual pickup in consumption. So this is something that we had anticipated at that point in time. The second key aspect is on the geopolitical landscapes. So we discussed that China is steering towards self-sufficiency, essentially in areas of energy, technology, and it's moving towards a more services-led growth model versus the manufacturing-led model that we've seen so far. And third, of course, very importantly, the policy pendulum you spoke of has swung towards a more restrictive but pro-growth approach. And the policy makers are going to be looking at the stimulus in a very different way now. So coming to my question to you, Alex, if we turn to you for sharing some insights on what's the current on-ground reality in China. So ranging from consumer confidence to private business sentiment to even foreign investors, how are they viewing China? If you could share some of the challenges, and of course we've seen some policy measures that are being implemented now, and we've seen some bouts of excitement of the last 2 to 3 months because of these measures. So over to you, Alex.
Wonderful. Well, thank you for the very kind introduction, and thank you to everyone who is watching this right now. So let's go to slide 5, please. And I think that the best way to start this conversation is just by sort of setting the scene for the extent to which China has a domestic versus an international story to it. Now, my experience of dealing with investors in India, and I've dealt with many, many investors in India, is they tend to look at China primarily from the international perspective. Totally understandable. But I think that is an increasingly outdated story, and we need to think China much more in terms of the domestic economy. Not that long ago, the driver of the Chinese economy is primarily its export industries, China's ability to make cheap things for lots of consumers elsewhere. But over the last 10, 15 years, that has shifted towards China being much more domestically oriented, and as Shikha said, much more focused on service versus low-cost manufacturing. So that's the first thing to understand, is that the domestic economy is much more important to China's outlook than was the case when I started my career nearly 30 years ago. So let's have a look at what's going on in the domestic economy. And just sort of summarizing before we get down into the weeds. The first thing is that, as Shikha said, we started this year with some optimism about the extent to which China would recover from the really stringent lockdowns, which just a year or so ago was still in place in China. And we think that that recovery has been taking place, but there's no doubt that it has disappointed. The next thing is, if we go back a year, the policy pendulum was still relatively tight. And although we should expect this to keep moving, for the moment, the focus is very much on stimulus, on growth, and so policy, we think, continues to ease. Having said that, it's easing incrementally rather with any big sort of bazooka burst. I'll talk more about that. And the other thing to address, of course, is valuation. So those are all positives. Now, on the weaker side, we've got one domestic factor, which is the property market, and we will talk about that. And then we've got geopolitics, although I would argue that the more recent meeting between Xi and Biden has been incrementally positive. So let's dig a little deeper. And if you go to the next slide, please, we're going to start by looking at how Chinese people have been saving money. And what you can see here is that the darker blue lines show the net increase in household savings in China over time, and the light blue bars show the net increase in household debt. Now, the more that the savings bar goes up compared with the debt bar, the more that net Chinese consumers are saving versus spending or consuming. And what you can see here is that the savings rate was going up over time, or the stock of savings, and then during COVID, it absolutely went bananas. And the reason for that is relatively simple. People like you and me, they were still earning salaries during COVID, so income kept coming in, but of course it's very hard for them to spend that money, particularly when they were locked down, because what could you possibly spend money on other than food delivery and other e-commerce and things like that? And so the savings rate went up dramatically. At the same time, there's been this clamp down on the real estate market, and that has reduced people's propensity to take out mortgages and to borrow to invest in real estate. So what all of that sort of amounts to is really dry powder, that the amount of wealth being saved in China has gone up a lot. Now, I think there are two fair questions from that. The first question is, will people spend it, and when will they spend it, and what would make them spend it? That's the first sort of set of questions. And the second is that wealth evenly distributed through society, or are there certain pockets that we should be looking at more closely? So on the next slide, what you can see here is that consumer confidence took a real hit, particularly towards the end of COVID, when China had lockdown policies which were more stringent than really anything we saw anywhere else in the world. And maybe somewhere like Pyongyang had tougher policies, but we don't worry about that. And as Shikha said, this contributed to a sort of a hangover in people's proclivity to spend. And it's been a while before people have started to recover their confidence. Now, our fundamental view is that this is a story of when and not if. But Chinese consumers, like consumers everywhere, are resilient. People like buying things. but it might take a while for them to get their confidence back to the levels they were at previously. Partly that's around just how tough the lockdowns were, and partly it's around what's happened in real estate more recently, so we will come back to that. So you can see on the left-hand side, the right-hand side of that chart, the confidence bounced at the beginning of the year, but it has since tailed off again. And it's a matter of being patient, I think, and waiting for that to pick up. On the right-hand side, this is a very clear example of the fact that where the wealth is in China is not evenly distributed. And so looking at the unemployment rate, for example, of people between the age of 25 and 59, so that's the light blue bar at the bottom of the slide, that's been relatively stable over time insofar as we're confident in the data. Conversely, for new graduates and for younger people, which is the darker bar where the mouse is hovering at the moment, the unemployment rate has been much, much harder. And so we think that, for one, we need to be a little bit patient around recovery. One of the implications of that is that consumers have been looking for cheaper goods. And so when we look at our e-commerce positioning, for example, we're looking at companies which are enabling consumers to save money by maybe doing the opposite of premiumization. They're buying cheaper goods for whatever they want to buy. But also on the right-hand side, we know that professionals have they've been able to save more than younger people in the gig economy. And so we also focus on that, for example, in areas such as the travel sector or alcoholic beverages. So not to look equally at consumption everywhere. Now, although the lockdowns were the key cause of the sentiment weakness you can see on the left, the reason the hangover has been so prolonged is on the following slide. So if we can go to the next slide, please. And this looks at what's happening in real estate. Now, what we need to do is pause and take a step back and ask, what is the desired policy outcome here? And what has happened is that, as you all know, Chinese economic growth has slowed. And partly that's just about mathematics, which is that the richer an economy gets, or the larger its middle class, the slower its natural growth rate from that point. So China's gone from being predominantly a low-end manufacturing economy to an economy with a much bigger middle class of consumers. And as a result, its growth rate slows. That's fine. Now, what the government wants, though, is that in return for that slower growth rate, it wants less boom and bust. So it wants less misallocation of capital in infrastructure, for example, and they also wanted less of this sort of super cycle pump priming through the real estate sector. They thought that the real estate market was undermining the health of the national balance sheet. And so very deliberately, they have squeezed the real estate sector. Now, my number one life rule is the law of unintended consequences. And although the government has achieved what it wanted to achieve in shrinking real estate balance sheets in aggregate, perhaps those measures have gone a little bit too far. They resulted in some low-quality businesses disappearing, which is fine. They've resulted in quite a lot of angst amongst consumers who worry about getting the apartments they've paid for, which is a much bigger deal politically. And so while they are not going to suddenly take all of the constraints on the real estate sector off, they have started relaxing a little bit some of the policies which relate to it. So what we think here is that the real estate sector isn't going to suddenly contribute to a massive growth burst for the Chinese economy, but the government has taken steps to take a lot of the risk associated with real estate out. And so this is in a more secure place than it was maybe 6 or 9 months ago. So we're not betting on positive real estate stocks, but we do think that the risks to the financial sector are not systemic and are much calmer than they were a few months ago. And we remind ourselves that quite a lot of this policy is deliberately driven. So on to the next slide, we'll have a quick look at some of the changes in policy. And the key point here has been that rather than there being any one major policy change, there have been lots and lots of little supportive things taking place at once. And the objective here, as mentioned, is not to return to a boom and bust economy. It's to put a foundation or a floor under some of the risks that people are seeing, to prevent anything systemic happening, and to encourage more growth to come back, but without aspiring to anything like the sort of 8 or 9% growth rates that we used to take for granted. And we think that this will bear fruit over the coming months. So it's difficult to time it, but the combination of the recovering consumer, of less risk in real estate and what that means for the banking system, of more policy easing, we think that's going to basically underpin a better picture of the domestic economy than was the case previously. But it might take some patience. So let me pause there, Shikha, and see if you've got any sort of related questions to that domestic piece.
Yes, of course. So thank you for this, Alex, for summarizing it so well for all of us. And also we see a significant amount of activity from the policy end. And these measures are sending out some positive signals in the market as well. So at this point, I think it'll be a good idea to even highlight some of the numbers that have come out, which have been positive in the last 2 to 3 months. So I just have some of these numbers. I'm going to read them here. It'd be good to know your view as well. And of course, how the markets are looking at these positive numbers. So essentially, the 3Q GDP growth surprised positively, 4.9% year on year. September retail sales have picked up versus the previous month. Household savings have started to decline. And of course, there are certain indicators that suggest the expansion will surpass 5% for the year. And also the consumer spending and industrial activity has expanded faster than expected in October. So how do you see some of these numbers? How is the market expected to react? And do we expect the Chinese economy to meet its targeted growth rate? Any quick comments on that?
Yeah, sure. Look, I mean, the key point about what you just said is most of the signs are pointing generally in the right direction. But let's remind ourselves that if you are hoping for a return to the China of 8% growth, you're dreaming. That's not going to happen. But things are better now than they were a year ago. The next thing just to say, however, is that if the only thing you focus on was the GDP growth number, you wouldn't invest in US equities. Because people invest in US equities despite the fact its natural GDP growth is much lower than in many other economies because it's already wealthy. And so I think that we can take these numbers positively. I think the way the market is acting is signaling to us that people are much less concerned about the domestic situation and much more about just the US 10-year, which is something which affects all of us, but also ultimately just look at individual companies. Because this is something which we need to coming back to again and again is for all that we need to understand what's happening in the Chinese economy, we don't buy the economy, we buy individual stocks. And that's a very, very important distinction. So what we'll come to a bit later is, can we find companies with good business models, almost irrespective of whether the GDP print is 4.9 or 5.1 or 5.3. Beyond a certain point, that's not really the issue.
Sure. Just another question at this point, Alex, is that how is the private businesses sentiment changing at this point in time? Are we seeing investment activities? Are we seeing hiring? So any comments on this piece?
Yeah, I think that and we have colleagues in China, based in China, and we have other colleagues who are visiting China just last week and sending their feedback. So I've got, this is hot off the press. I think there's no doubt that business sentiment is not as robust now as it was a couple of years ago. And we need to remember also that, of course, that when we talk about private business sentiment in China, that's not the same as private business sentiment in India. China's government plays a much larger role in just everyday life than would be the case where you're all based in India. So I think the private sector needs to get its mojo back a little bit. We need to see more animal spirits come back. But there's no quick fix to that because people remember what has happened over the previous months. But the more that the government can just reassure people that policy is moving in the right direction, that it's pro-innovation, that it's not anti-entrepreneurial spirits, then over time that will bear fruit.
Okay, that's helpful. Also, how are the foreign investors reacting right now in terms, and how do we see the flows impacting the market?
Okay, so at the beginning of the year, lots of people were very positive. at the moment, people are a little bit more risk averse, but that's not something which a comment I would make only about China. As mentioned, I think it's the US 10-year which has got most people's focus across emerging markets more generally. We have seen maybe a tailing off of flow year to date, and we've got big market share, so I think we're quite a good indicator of what's happening more generally. Our clients in different geographies have got different views, so typically investors in Asia are much more open to the idea of buying China on dips than might be the case out of the US. But really, I think the flow picture is not the key driver here. Most of the time, the wrong reason to invest is on the back of what you think is happening from any particular set of flows. The key thing to focus on is earnings. And if we see a bottom in earnings and we see the earnings pick up and valuations then on the other side of that coming off, then that's much more important to focus on than who the marginal buyer is. This is a very liquid market still, so we don't see any issue with flows. There's no sense of any sort of emerging market crisis or something like that.
Okay, that's good to know. And how do you see the contribution by the domestic players in China towards the Chinese markets? So do you see that we can expect some flows from domestic participants as well?
I thought so. Yeah, absolutely. The Chinese fund management industry is still relatively young. It's still relatively immature. It's very volatile. But I think that the key thing to understand about the domestic participation is that it generates pricing inefficiency. A lot of domestic investors have got very, very high portfolio turnover. They're very sentiment driven. They are quite prone to sort of chasing whatever the hot new idea is. And if you've got a robust methodology and you can take the other side of that, I think that's really important. So particularly the onshore market, so the A-share market, it remains an inefficiently priced asset class, which I think over time gives us good alpha opportunities.
Okay, great. That's helpful. So, Alex, having discussed the broad construct of the Chinese market, Taiwan also occupies a considerable portion of our portfolio. And also what we have learned is that finally the exports have started to grow, witnessing a decline for about 12 to 13 months. And also what was interesting to learn is that the domestic consumption also is quite resilient and contributing towards GDP. So how do you see the Taiwanese market shaping up from now on?
Well, I think that different markets can have different areas of expertise. And so if we look at the Indian market, for example, this is a stock market which is characterized by some fantastic private sector financials, for example, by some consumer stocks, by IT services. But I don't think that anyone is out there saying that India is at the forefront of tech hardware, for example. Conversely, Taiwan has got a financials industry, it's got a consumption industry, it's got telcos. But where Taiwan really stands out is it's got a number of companies, most notably TSMC, which are absolutely at the forefront of tech hardware innovation. Now, that's important for two reasons, at least two reasons. The first of those at least two reasons is that we think that the semiconductor cycle more generally is turning. So inventories have come off, and that's going to be extremely positive for Taiwan. That's a cyclical thing to focus on. Behind that, we've got the structural story, which is that AI is the big thing that we're all talking about. And that's not going to change over the next year or so. And of course, while we don't know how AI will be applied to many different business models, while we can kind of assume that it might disrupt and improve our lives, but we don't know how to monetize it, all of the AI needs more semiconductors, it needs more servers, it needs the pipes which plug things together, basically. And Taiwan is at the forefront of that, much more so than China. Now, China has got the self-sufficiency story. It's a much more high-tech place than it was 10 or 20 years ago. But if you want bleeding-edge semiconductors, you go to Taiwan or Korea. So I think that the way to think about Taiwan in this portfolio is that to some extent it complements some of what we see from domestic China. If you want internet giants, you go to the Chinese stock market. If you want maybe energy transition, you might go specifically to the A-share market. If you want tech hardware, the best tech hardware, you probably go to Taiwan. And if you want financials out of all the markets in Greater China, you would go to Hong Kong. So there are sort of different pockets of attraction in different places.
Okay, that's wonderful. And I think Alex is a good point now to pivot to our portfolio. So while we see structural changes in the Chinese market growth, what are some of the new areas of opportunities that you see, and how is the portfolio structured to capture these opportunities?
Absolutely. So let's go to the next slide, please, these key investment opportunities. And this ties back in with what I said previously, which is not that long ago, China was all about making cheap sports shoes and transistor radios for you and me to buy. But that has changed dramatically in 25 years. So where we see opportunities, these long-term secular growth opportunities, are in things like technology, carbon neutrality, and consumption. And if you've got sharp eyes, you'll see that in those consumption bubbles, one of them is a stethoscope and one of them is a microscope. In other words, that includes healthcare. And, excuse me, when we sort of look across this, I think one of the unifying factors that we see here is the new economy. We are very interested in the new economy in China, much less so than in the old economy. Partly because the new economy is synonymous with innovation, the old economy less so, and partly also because the old economy is dominated much more by the sort of state-owned enterprises that we're less interested in. We prefer the private sector for all that. Nothing is immune from government pressure to some extent in China. So let's elaborate a little bit more on some examples here. So if we go to the next slide, please. When we look at technology, quite a lot of this, as you can see in the headline, is about industry upgrades and import substitution. Excuse me, and we've got a surprisingly long way through this call without really getting into geopolitics. But geopolitics are a thing and they will persist. And one of the outcomes of geopolitics is that China wants to become self-sufficient in an array of areas where previously it was able to import things. So when we look on the left-hand side, not that long ago, China did not have a semiconductor industry. Now they do. As discussed, it's not as good as the Taiwanese semiconductor industry, but nevertheless, when you want commoditized semiconductors, they're useful for something. And so companies like Montage or Foxconn are beneficiaries of this. We've also got automation. China will be using fewer workers to do manufacturing than in the past. Workers are getting more expensive. They're getting scarcer in a graying economy. They are also maybe less efficient than their robot equivalents. And so we see stocks like Shenzhen Inovance, which are automation plays. And then also, of course, we've got homegrown software. And presented with a choice between buying maybe the new Microsoft product and buying the domestic equivalent, if people are a little bit concerned about how sanctions might impact one versus the other, or the ability of the US government to say, well, we don't like you supplying this particular bit of software to China, then that's a very strong following wind for domestic players. So that's one sort of area that we're looking at. And the nice thing about technology is it's not just one or two business models. We've got some tech hardware, we've got some factory automation, we've got some software, so lots of different ways of playing the broader theme. On the next slide, we will echo some of that in carbon transition. So the first thing is the solar industry, and China in short order has gone to dominate the solar industry globally. And this is partly around manufacturing for export. It's partly also the fact that, of course, what some of the geopolitical challenges in the world have underscored is the importance of China's own domestic energy security. And a bit like India, China imports oil. And if they're worried about that, they're worried about the source of the oil, the best way of dealing with it is to make sure that they can generate their own energy, for example, through solar. Then we've got the tech enablers for the old China transition. And to some extent, this ties back in with the automation story on the previous slide. But this is really Chinese companies becoming more efficient in their manufacturing processes, for example, in steel mills, so they're less polluting along the way. They use less energy for any given unit output of steel. And on the right-hand side, we've got electric vehicles. And China has done a really remarkable job of accelerating the development of its electric vehicle industry. What the the two lines you can see on the right-hand side there shows that recently our analyst has upgraded his assumptions about how many EVs there are in China. And although the EV companies themselves aren't always the best way to make money, if you can buy the suppliers to them, for example, in the battery supply chain, then that feels like a really good idea to us. Again, it's quite new economy stories. And then very quickly on the next slide, a little bit less new economy, is then also in consumption. And we know that as Chinese people get wealthier, they will buy more consumer goods. Right now, there's a bit of downgrading going on amongst more price-conscious consumers because of the slower economic recovery that we've talked about. But over time, people will consume more and better. And part of that consumption will be looking after their bodies and their minds, and you can see that in the middle and the right-hand side columns. So this really, Shikha, is how we're positioned. It's for newer economy, it's for consumption, it's quite domestically oriented, there's a lot of technology in there. It's much less around commoditized manufacturing for export.
So, Alex, I think it will be helpful if you could share some more insights on how is our portfolio currently allocated across these themes, and also in case you've made any changes in the current year in the portfolio across these themes.
Absolutely. So if we jump ahead, please, to slide 24, we're going to start there. And what I just want to say is that we have a very pronounced philosophy. We think this is we know it's a broad market, we know it's a liquid market, we also know it's a volatile market, and we think there are lots of mispricings. So that means we want to be active stock pickers. We also think that a lot of our customers want to invest in China for growth, because while the economy might not be growing as quickly as it did in the past, it's still growing much faster than the US or Europe or Japan for that matter. And also, of course, we can find companies which will grow much faster than the economy itself. So we're growth investors. And then we know that there are good and bad neighborhoods within the Chinese equity market, and we have a focus on quality. We've also got a high conviction approach. So this is not a portfolio which resembles the benchmark. This is a high quality growth portfolio, very bottom up, with strong conviction, and our positioning is dependent on all of those statements. So if we go ahead now to slide 27, please. What you can see here is that we are overweight IT. So that's the row of bars on the top half of the page on the left. Thank you very much. We're overweight communication services. And you might be thinking, wait a second, communication services, is that telephones? And the answer is no. That's internet stocks in areas such as social media and gaming. So Tencent, for example, which you'll all have heard of, that's not an IT stock, it's a communication services stock. We're overweight consumer staples, and I've talked about consumer names. And then our underweights are dominated by old economy, materials, energy, consumer discretionary, which includes e-commerce, but also the electric vehicle manufacturers. And as I said, we prefer the supply chain to the OEMs. And then most notably, underweight financials. If you want the best banks in the region, they're not in China. A lot of them are in India. So we typically are underweight that sector. No, not typically, we're always underweight that sector. There are some higher quality franchises within that space. We've been adding a little bit also to capital markets plays, but generally speaking, there are better homes for our capital than in financials, which I think is a really important point, because if you're an Indian investor, you're probably quite exposed to financials, much less so to, for example, internet or tech hardware. Conversely, in this product, we're not giving you a lot of financials, and we're giving you a lot of internet and tech hardware. So they're quite complementary to each other. We're overweight China, we're slightly underweight Hong Kong, and we're a bit more underweight Taiwan. And that's because although we like the tech in Taiwan, we're less keen on other parts of the market, such as banks or consumption.
So just staying on this slide for a bit, Alex, just wanted to understand, are there any short-term plays in the portfolio, or most of these names you consider as long-term, most of these sectors?
Well, Shikha, we are long-term investors, as you know. And so we're always going to try and take a longer run view on business models. Having said that, we would be much more price sensitive in some parts of the market than others. So I think the best example would be comparing a stock like Meituan, which is a food delivery service, is a little bit like Zomato maybe. And this is a business which we think has got a differentiated business model. It's got long-term barriers to entry. It's got multi-year growth prospects. It's a pretty high-quality franchise. And I think that'll be represented in the portfolio for a sustained period of time to some extent. Conversely, if we look at somewhere like capital markets at brokers, now if we see a recovery in the Chinese market, which we think is entirely possible, if we see a bit more beta coming back in, if we are a little bit worried about the extent to which we're underweight financials, then the domestic brokerage or capital markets play would be a way of managing our risk in that respect, but would be much more sensitive to valuation there. So we're always going to have a long run view on business franchises, but we're going to be more price sensitive in some parts of the market than other parts of the market.
Sure. Also, Alex, some time ago you mentioned that we need to focus more on corporate earnings and profitability. So how does our portfolio stack on these metrics?
Oh, let's go back to the previous slide, please. We'll put some numbers on that. So on the left-hand side, we've got our portfolio characteristics versus the benchmark. And what I would like, please, is for everyone to look on the left, 3 lines up from the bottom where it says 5-year expected growth rate. And what you can see there is that the portfolio has got a 5-year annualized expected growth rate, which is nearly 5 percentage points higher than the benchmark. So we're clearly trying to buy companies which are going to grow faster than the broader opportunity set. And if we go 1 line up from there, you can see the return on equity, which is the simplest measure of quality. And there again, you can see that we've got an ROE which is meaningfully higher than benchmark. So having said this is a growth and quality portfolio, that's your growth and that's your quality. Now, you won't be surprised to hear that that comes at a bit of a price. So if we look, for example, at the top line of that table, then the portfolio is also more expensive than the benchmark. And this is why it's important for us to have a long run perspective, because in year 1, the PE is quite a lot higher than the benchmark. But if we take a long run view on our stocks, and if they keep on growing so much faster than the benchmark, then that valuation differential narrows quite quickly. And that will look after itself. Now, this, I think, is the single biggest risk to the portfolio, is that it's a growth portfolio, and when value outperforms, which is something we've seen over the last year or so, then that inevitably creates a headwind for us. But we don't want to buy low-quality value franchises just because they look a bit cheap. They're cheap for a reason. We don't want to change our style. We're going to stick with the companies we think will be worth more in 3 and 5 years than they are now. And if we're correct on that, then our portfolio will be worth more as well.
Sure. Just staying on valuations, how do we see or read valuations from a China context?
Well, I'm glad you asked that. Let's have a quick look at, I think we should go to slide 13, please. And this puts valuation in a historic context. So what you can see on the left-hand side here is that the PE ratio is now meaningfully below its historical average. And so is the price to book. Now, the reason that's happened, of course, is that profitability has come down. But if we assume that the business model in China is not broken, and I don't think it's broken, and if we assume that at some point there'll be a cyclical upturn, then these valuations will re-rate in due course. What we have to do here, though, is an exercise in expectations management. And I think your entry point to our industry or to looking at China is very important here. If you go back 5 years and you say, well, how is China positioned versus 5 years ago? I think it's a little bit more challenging right now. 5 years ago, people were incredibly enthusiastic about China. It felt a little bit like the West Coast of the US. It was kind of the new thing. And frankly, that was maybe a little bit unrealistic. So compared with 5 years ago, it's a slightly tougher environment. But compared with when I started in the industry, sadly, in Asia in 1996, there were no Chinese companies to invest in offshore. So everything we're talking about has happened since that point in time. And compared with then China is in a meaningfully better situation. So if you think China is the next Silicon Valley, you're probably going to be disappointed. If conversely, you think this is a market which is innovating meaningfully over the next generation and will continue to innovate, then I think there's a lot to be enthusiastic about. And these valuations will then over time start looking more attractive. Maybe not next month, maybe not the month after, but as the earnings compound up in due course.
So, if you could just share some highlights on the recent performance of China, I think that will be helpful over the last few years, because we've noticed that the last 2-3 years, the returns have been challenged, and of course, China as a market is quite volatile, and it has seen its bouts of volatility and very high returns, and then of course negative returns. If you could take us through the trajectory of returns, would be helpful.
Sure. Well, actually, tell you what, let's start with a really important chart, which is slide 12. And you've hit the nail on the head by saying this is a volatile market, because it is. And the reason it's worth kind of re-emphasizing that very obvious statement is by accepting that, it puts a lot of other things in context. If you are hoping for a market which will give you a very smooth and steady ride over time, please look elsewhere. Conversely, if you can accept some volatility in your portfolios, and I suspect that as Indian investors you can, and we look at the volatility we've seen over the last couple of years, actually, in a historical context, it's not unusual. So that blue circle you see underneath each of the vertical dark blue bars, that shows you the peak intra-year decline in each of the last, what's that, sort of 20 or 30 years. And although this year has felt tough and last year felt tough, looking back through history, they're not that unusual, the numbers. But over time, China has worked. It's just that you need to be able to suck up the bad times as well as the good times. The other important thing about this, and let's go back to slide 31, please, is this is a very good reminder that it can be extremely dangerous to sell volatile asset classes after they've fallen. But of course, what tends to happen is that after the market's gone up, the phone rings off the hook with people saying, should we be buying China now after it's gone up? And after it's gone down, they're saying, well, should we just give up on it? Was that it? It's all done. And I kind of keep reminding myself to think about this in the opposite, which is in a volatile asset class where you believe in the longer run story, you buy it after it's got down, not after it's gone up. So focusing a bit more on this, on the bottom half of the page, we've got calendar year performance. And to Shikha's point, we have pretty volatile returns on the way down, all the way up. The next thing just to point out is it's highly unusual that we get 2 or 3 consecutive years of negative returns. Normally, after 1 or 2 years of negative returns, we get a bounce, and I don't know if that will happen, but I hope so. And then the final thing on the top half of the page is that although the last couple of years have been tricky, on a 5-10-year inception basis, we've still added value over time. And remember that all of these numbers you're seeing are A, after the market's gone down by well over a third, and B, in US dollar terms. So actually, if we assume that the market will recover at some point, and we think about how this might behave in rupee terms, while I would never, ever, ever counsel that an Indian investor puts 100% of their assets in China, I do think it's got a place in a diversified portfolio in your neck of the woods.
Absolutely, Alex. In fact, it seems like a very interesting juncture. So if we have to look at the numbers from a number perspective, or from a return perspective, or even from what is happening domestically and its relations, of course, even globally, and how it's trying to reinvent itself and change its current business model, I just feel it's a very interesting point for China in general.
I hope so. And what we need is always super simple. Find companies with barriers to entry and good technology or good products which will be worth more in 5 years' time than they are now. If you get that right, the rest of it looks after itself. Now, we need to pick the right stocks. We need to make sure that this huge abundance of capital within China doesn't compete their returns away. And we also need the government, frankly, just to take things easy for a little while. But as long as Xi Jinping is prioritizing growth, then I think the odds of that last thing happening are pretty good. And then we need the earnings to come through. If the earnings don't come through, then we will just be, I think we'll just go sideways for a while. If the earnings do come through, then it's one of the cheaper markets in the region. And I should say that much as we love Indian equities, Indian equities aren't cheap. They're amongst the most expensive equities in the region. So I'm always a fan of trying to find a bit of a bargain if I can.
Sure. So so I have some questions here, Alex.
Right.
So yeah, it's a good time for all our participants to post their questions in the comment box. So just starting with some of the questions that I have here with me. So changing demographics is a key reality for China. So what could be the measures that are being adopted by China? Of course, you've mentioned that automation is one place where China is taking this particular area very seriously, and we see significant strides being made in this area. So how do you see China taking on this particular challenge?
Well, I mean, the very facile answer is, well, you've talked about automation, but also China has said to people, you can have more babies. Telling people they can have more babies and people wanting to have more babies are not the same thing, right? Babies are expensive and the education is expensive and it's challenging and people are used to the one-child policy. So that's not the panacea. The real answer to this is that, in my view, you should not run your portfolio on the basis of demographics, ever. Now, let's go back to that performance slide, if that's okay. So slide 31. Because the thing about demographics is they play out over very long periods of time. The one-child policy was in place for decades. And for the duration of that, anyone who's more than 8 years old and can add up two numbers will figure out that a one-child policy, by definition, means the population will shrink at one point in time. It has to happen, right? If you replace every two people with one person, the population will shrink. The thing is, that was true for all of the years we can see on this table. In 2013, we knew that the one-child policy over time would result in a shrinking population, and the market went up 7%. In 2014, we knew that demographics would be a challenge at some point in time. The market went up 8% in US dollar terms. 2015, it went down. In 2016, it went up. 2017, is anyone telling me that the Chinese population was growing dramatically in 2017? No, it wasn't. And the market went up over 40%. So what happens is that when people are feeling negative about China, they will start invoking demographics. Oh, it's got an aging population. That's a bit of a problem. When people are feeling good about China, they're going to forget all about that. They're not going to mention it. So it's just an excuse in bear markets. The point is, if you can buy companies which will grow their earnings over time, then don't worry about the demographics. The birth rate will, look after itself. I don't know. Get the companies.
So any other risks that you can highlight, Alex, from a medium to long-term perspective, because that can be a key part of consideration for investors?
Well, I think there are probably two key risks. One is domestic, which is that the government goes too far in the total domestic control, single party direction, clamping down on entrepreneurialism. And the reason I don't think that's a huge risk is because actually of something very basic. If we reduce this to its simplest statements, we know that Xi Jinping wants China to be a superpower. We know that. There's no debate. We also know that for China to become a superpower, if it isn't one already, it will need to innovate. Because you can go from being a low-income country to a middle-income country by making stuff, but to go from middle to high, and then to become this superpower as part of that process, it has to be around innovation. And so we think that the government will not squeeze all innovation out of the economy because it runs directly counter to its single most important strategic imperative. And if we just reduce everything to sort of, military industrial terms, China is a military power. It wants to be a bigger military power. It wants to be a more advanced military power. You need technology to do this, which is one reason that the US and China there's this tussle around the most sophisticated chips. It's not because the US wants to hobble China's e-commerce industry. It's because it worries about the domestic, the military application, cutting edge chips. So we don't think that the government will strangle all innovation because of this, but it's something to be aware of. And then onto the key external risk, well, I just mentioned it, which is geopolitics, which is that put very simply, the US doesn't like having another superpower. And China doesn't like the US not liking having another superpower. So they'll keep squabbling. And Xi Jinping and Joe Biden seem to have constructive meetings, which is incredibly good for all of us as human beings, because we want the military talking to each other. But directly afterwards, the Chinese government did some naughty, the military did some naughty things. They set off a sonar near an Australian ship in the South China Sea or somewhere like that. And there'll be these speed bumps along the way. The Philippines complained about China's behavior directly after Xi's meeting with Joe Biden. I think there'll be push and pull, but unlike, for example, the US and Russia, where the US can live without Russia, the US can't live without China and vice versa. So hopefully they will find an accommodation on all the trickiest issues.
Thanks, Aldous. That's very helpful. The other question that we have here with us is how is the portfolio structured in terms of market cap, large, mid, small? If you could throw some light on that.
Yes, absolutely. Now, I'm pretty sure that if we go to slide 26, we have the data. And the answer is that in absolute terms, the vast majority of the portfolio is in stocks which are over $10 billion. So if you look at the bottom right-hand side of this chart, you can see that about half the portfolio is in stocks with a market cap of over $30 billion. And that's partly because if you like the internet stocks, which we do generally, that pushes you towards these big names. We've got a whole bunch in the 10 to 30, but we also have some smaller companies. Anything below $1 billion is getting a bit of liquid. But we think there's some interesting opportunities in the $1 to $5 billion space. And these will be the sort of companies which your clients won't have heard of. And so I think we're pretty well spread there. Versus the benchmark, we're not taking huge positions either way.
So also, I think good time to even probably share with us the top holdings and how we underweight, overweight. So I think it'll be helpful for our participants.
It'll be my pleasure. Thank you. So on slide 28, on the left-hand side, you can see the top position. So let's have a quick rundown some of what we've got there. We've got TSMC, Taiwanese company. You've all heard of it. This amazingly impressive semiconductor foundry. We've got Tencent, which is social media, gaming. We've got Meituan, which is food delivery. I talked about financial services out of Hong Kong, and AIA is a good example of that. We've got some gaming. We've got some e-commerce. Trip.com, this is interesting. So this is China's largest online travel agency. And that's significant because we do think that people will spend more cyclically and structurally on travel. And then we've got some more financials and technology. The key underweights, technology hardware, I should say, the key underweights, you can see that although we do have some investments in Alibaba, we're underweight that stock. It's our biggest stock in the portfolio. And the simple fact there is that this is a company which got very big, which we think is not growing as quickly as some of its competitors, such as maybe, a stock like Baidu. They are, they kind of lost their way a little bit with capital allocation. And so we think there are better opportunities in the internet space. We're underweight TSMC despite all the wonderful things I've said about it. And the problem here is that by the regulatory rules of the regulator which governs this portfolio, we can't have more than 10% in any individual name. So it's nearly 10% of the portfolio, but we have to be underweight the benchmark, which is now about 12%. Pinduoduo, so this is an e-commerce food, agricultural product e-commerce company. We find better opportunities elsewhere. And then a couple of financials. China Construction Bank, it's a huge bank. The banks are, in essence, instruments of state policy. They're not run for you or me. They're not growing very quickly. They're not particularly profitable. So that's one that we avoid. And Ping An Insurance is actually quite a high-tech and interesting insurer, which we think lost its way a little bit, first with a restructuring of its agency force, which slowed growth. They made some unwise investments. They have some real estate exposure. And so we slightly lost faith with management there. And if we don't like the management team, we don't want to invest with them.
Just moving on to our next question. So there is a general consensus across global fund managers on reducing allocation to China. So do you think this can be a reason for it to underperform?
I'm interested where this consensus is coming from, because I would say that, although, as mentioned earlier, our US investors, for example, some of them are placing China in the too hard bucket, and they'd rather just get a general gem exposure. More of my conversation in Asia are about buying dips than about selling any bounces. And so I would be a little bit wary about that assumption. Now, I will accept that China's had a difficult year. That's true. But we haven't by any sense had a sort of a capitulation, capital outflows, huge amounts of money coming out. That hasn't been an issue for us at all. I also think this is partly around time horizon, which is, we think there's a lot of investors out there who understand that particularly the onshore market has got very low correlations with other equity asset classes, that it is inefficiently priced, that it is very liquid, that there is a broad opportunity set. And so they quite like that combination of circumstances. They just need the environment to get a little bit better. You know what? If any individual foreign investor wants to sell Chinese equities, that's entirely up to them. I can't second guess what they're going to do. I respect their judgment. What I need to do, or what my colleagues need to do, is find companies which will be worth more in 5 years' time than they are now. And that's what we have to focus on.
Sure, wonderful. So another question that we got here is that at the current valuation levels, would it be recommended to put in lump sum investments or invest into China in a more systematic way? So here in India, SIP, systematic investment plans, have been doing really well. So people have been investing on a monthly, weekly, or a quarterly basis. So what would be recommended here? Of course, a thematic strategy, it's a very volatile strategy. But would you recommend that at the current valuation levels, is it advisable to invest lump sums, or it's just better to go the systematic way?
I think that might be a trick question, isn't it? The answer is I'm always going to argue for investing systematically. I'm always going to argue for diversified investments. I'm always going to argue for being stock specific and fundamental. I'm always going to argue for going with really robust analysis. And so I think that particularly for anything, but particularly for a very volatile asset class, if you go in with lump sums, that's a little bit like saying, you know what, on the roulette wheel today, we might get black. I'm going to put it all on black. It could go up 30% next month. It's not impossible. It could also go down another 10% next month. So I would always spread my allocations over time. And of course, by doing that, you're taking the emotion out of investing, which is important for all of us. And you are just letting the system work how it should. So, but I mean, you can ask me that at any point for as long as I'm working until I retire, and I will give you that same answer.
Sure, very helpful. So also a little bit, there's a question on understanding the benchmark of the fund.
Well, I mean, put very simply, the benchmark is a combination of Chinese equities, which is the biggest piece, and Chinese equities are divided between onshore, so the A-share market, and actually I think that maybe slide 27 is useful in this respect. So the onshore market is not generally available to foreigners. It's harder to access. We can access it because this is what we do. We've got various routes in through QD, through Connect, through participation notes. And you can see there that about 60% of the benchmark is onshore. A-shares is maybe 5 or 6%, and others, which is the Hong Kong market, ADRs, etc., is more. And then we've got Hong Kong, which is actually relatively small, and that's not a particularly large capital market. Basically, financials, real estate, bit of manufacturing, bit of conglomerates. And then Taiwan is about 30% of the benchmark. So the lion's share is the Chinese market, onshore and offshore, and then Taiwan, and then Hong Kong, all within what we regard as the Greater China region.
Okay, that's helpful. So I guess we're almost near the close of our session. So before I hand it over to you, Alex, for your closing comments, I think just quick key takeaways from my end. So quick 2 points that number one, of course, we've seen that there are certain challenges that exist in the Chinese economy. which have had a bearing on the recent performance. But thanks to the cautious measures being undertaken, now we do see that China is being propelled in the direction of growth. And this is one aspect that is being now recognized across. So that is one point that I'd like to make. The other point, while of course we see that overall the Chinese economy, we may not expect it to grow over the long term at the same rate at what we've seen in the past, but there are several new areas of opportunities and sectors and themes that can be expected to grow at a higher rate. So I guess these opportunities provide a very interesting time. And of course, we went through the valuations and the return numbers. So it just feels like an opportune time to allocate to China. So if you could just share your comments on that.
Well, I think you've done my job for me. That was a very effective and astute summary. It has been, without doubt, a disappointing couple of years, partly for self-induced reasons and partly for reasons which were sort of external to China. We think that all the different things which are aligning generally are pushing China towards a more positive direction. But I think you need to be mentally prepared up front that this is a volatile asset class, that it is a single party controlled economy that doesn't preclude success, but it means it will behave in a certain way. And then it's a matter of finding the right franchises in quality growth businesses at the right valuation, and then exhibiting some patience. We are unembarrassed to be long-term investors, and I think there's really no other way to play this asset class in an institutional fashion.
So thank you so much, Alex, for joining us today, and thank you, participants, for taking out time today, first Monday after a relatively relaxing week. So thank you so much for your time. For any further questions, please reach out to your respective Edelweiss RMs. We'll be happy to help. Thank you. Thank you, Alex.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.